and they are both here in moments. In fact, right now. So let's kick things off with the big turn in stocks. It is a sell-off, but really that doesn't tell the story because markets were up about 1,000 points. So while you may look at the numbers and say, we're not down that much, why are we seeing all the sell-off graphics? It's because the turn from the top to where we are has been over 3.5%. We are joined now to kick things off by the aforementioned Steve Sosnick. He is chief strategist at Interactive Brokers. Steve, thanks for joining us really on short notice. I know you're very busy today. We'll keep it quick. NVIDIA and its stock move certainly getting all the attention, but you flagged to us earlier today that it's possible Bitcoin and the crypto complex also help spark this big turn. Why and what specifically did you see?
Hi, Brian. To me, it was kind of uncanny. I was on the phone with someone discussing, how good the market was doing. And I said, Bitcoin is starting here to flirt with 90,000. If it breaks, I have a feeling that the S&Ps can follow. And it was uncanny. As soon as we broke 90,000, down went the NASDAQ and the S&P 500. I'm not going to say that Bitcoin is the reason that we had the big intraday reversal. Bitcoin was the proximate trigger because I do think right now algorithmic traders are using Bitcoin as what we would call a lead. It's right now it's being used as a proxy for speculative fever. If I'm noticing it and you're noticing it, algorithms are noticing it, and so money is being allocated on this rationally or not.
Well, is money
that's where we stand.
Is money also being raised? Is Bitcoin maybe, if not a leader for stocks, is Bitcoin at least an indicator for something like liquidity, retail liquidity in the market? People have to raise money, so they sell what they can.
To a certain extent, yes. I mean, many people are up. It depends. The newer travelers are not up because we are down for the year, but we are still well above where we were before the presidential election. And also remember, a lot of the crypto complex carries a lot more leverage than stocks. Stocks, you can't lever up the same way that you can do in crypto. And so as a result, if that starts to break, it's much more, it adds a lot of fragility to the system.
This is a critical, as usual, Steve, critical aspect that you are bringing up. And I want all of our audience watching and listening to hear again what you had to say, which is this idea of leverage. It's not that you're buying a Bitcoin or selling a Bitcoin. You can leverage up 2 to 1, 3 to 1, 5 to 1, 10 to 1, or even more than 10 to 1. Can you not? And that leverage means if things go up, it's very good news. But if things go down, you've got to have that capital, have that cash and money available for you to raise. And this is the danger. I think today is very indicative of this idea of what leverage can do in the stock market.
Exactly. Leverage can be a great friend when it's going your way, but it could be a very nasty companion when it's not. And what happens particularly in a lot of cases, the idea of waiting for the margin call, for the margin department to call you up and get money from you isn't the case anymore. At Interactive Brokers, we move very quickly and people unfortunately do find themselves liquidated. That's the model in the crypto world. And what happens is if you do these trades, it's great when it's working, but there's a lot of risk. There is always the balance of risk and reward. In the recent environment, people have been paid for embracing risk. In the current environment, where it's much more balanced, you've got to be much more careful about embracing leverage.
Yeah, and I want to be clear, we are down. We're at session lows right now. I'm not making light of a 1.75% decline in the NASDAQ. That's a pretty steep drop, especially in what's been a solid bull market for the last couple of years. But the market story is not that we're down 1.75. It's that we were up more than 1,000 points of the Dow and that things have certainly turned around. Maybe it wasn't Bitcoin, Steve. If not, is there something else that you saw? Because we woke up to green. We woke up to futures up. NVIDIA was up more than 2%. We thought, all right, this is buy the dip. This is the all clear signal. Clearly not the case, at least not today.
I think the other things here are, first of all, this is now becoming a key reversal where you have higher highs and lower lows if we finish at these levels. That's technically pretty nasty. But in general, what's gone on is there's just, the part of it is also the market's willingness to chase rallies. So I think what happened was when we woke up this morning, the S&P futures, NASDAQ futures were up about 1%, and that was okay considering NVIDIA was where it was. But the need to chase this thing to up 2% is what makes it fragile. When you lose a little leg of the stool, down you go much faster.
Well said. Steve Sosnick, Interactive Brokers. Steve, appreciate you jumping on. Thank you very much. All right, joining us now is Fundstrat's Head of Research, CNBC contributor Tom Lee, also the chairman of Bitmine Immersion Technologies, an Ether Treasury company. All right, so Tom, you've heard what Steve had to say. This is, by the way, not unusual for NVIDIA, is it? NVIDIA, the good folks at Bespoke, your team, you've recognized that NVIDIA will often have these kind of wild swings following earnings, but what is your take right now on these markets?
Well, I think I'm going to kind of add to what Steve said. You know, I think the crypto market has been limping along since October 10th because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. I mean, they act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, that was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stablecoin's price varied from other exchanges. It actually, stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out, as that spread across other exchanges, right, because liquidations cascade, almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, you know, Brian, I am aware of names, but because, you know, I'm not someone who wants to name names, I think what you should keep in mind is that this error is actually essentially a bug, you know, a code error, because I think in retrospect, they would have pulled pricing from across exchanges to set the price for that stablecoin rather than rely on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, you know, things go down at the airport and they say, well, a glitch clause, your flight did not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Yeah, I mean, Brian, it is. I mean, for instance, in 1987, Portfolio insurance was the, quote, glitch, and that triggered the cascade in 1987. And so the industry learned and then never offered that again. You know, in 2009, it was really the collateral wasn't secure in real estate in these packaged subprime mortgages. Now, the industry learned and they recoded that. I'm talking about Wall Street, but then regulators came in and like overregulated. That was the negative effect of that. In crypto, this code of ADL and the way they pull prices is never going to happen again. The good news is we're not going to have overregulation in crypto, but now we have to deal with that liquidation effect. 2022 was a big liquidation, and it took 8 weeks. But that is not kind of, you're right. It is the nature of DeFi where there is going to be code and there's going to be an error found. And you said it, leverage is what's dangerous. And so investors should not be using excess leverage in crypto. But
you
Tom
implied
DeMarco
it in 2022. In 2022, we had what you would call a 6-week washout, maybe because of this, again, not using the word glitch, this software or coding problem or mistake. 6 weeks later, we know what happened. If you bought then, you made a lot of money. Do you still think we are in a washout period in an overall bull market?
Yeah, I mean, I can tell you a few things. Whether we're talking to macro funds or to crypto funds, they are sitting on piles of cash. People are sitting on their hands because they know there are these plumbing problems and these crippled market makers. They're not going to try to be heroes and step in here. So when we look at those prior corrections, even Bitcoin in the last few years, Bitcoin last year had some really ugly corrections. Each of them had the recovery, right? The rise from the low was faster than the drip to the bottom. So if we've been suffering through 6 weeks of Bitcoin falling from 125 to 88, and maybe it goes to 77, right? Maybe that's the low, and Ethereum bottoms at 2,500. The recovery from there to all-time highs will be faster than the decline. That's what happened in every crypto decline, because what you have is all this spooled up energy. People are sitting and waiting, and there's panic selling, forced sellers, but the buyers are being patient. That's what will happen. And again, you guys kind of hit it on the head. MicroStrategy is probably the most important stock to watch right now because that is the Bitcoin proxy. It's the most liquid name. It seems to me that when in the crypto world, when they're trying to hedge their longs in Bitcoin and Ethereum, they can't find any other way to hedge it except shorting the liquid stocks that
This
are the
reminds,
proxy.
okay.
So that's the MicroStrategies.
This is one of, if not the most important interviews I've done this year. And that's respectfully to every other guest we've had on this fine network and fine show. Because I want to dive in a little bit deeper to what you're saying. That basically there's some kind of a software coding problem that's causing a lot of this. Let's bring up, guys, if we can, MSTR. That is the company formerly known as MicroStrategy, now just known as Strategy. The stock's down 50% in 3 months, Tom. It's down about 65% from its highs in the middle of July. Is MicroStrategy down because Bitcoin is down, or is Bitcoin falling in part because the strategies of the world, the Michael Saylors of the world, have to sell the crypto because their equity is going down? What's the chicken? What's the egg?
Yeah. Well, again, because of my world in research and on BitMine, we are really plugged into all the trading desks and all the clients that trade. Anybody who has a sizable Bitcoin long position, okay, let's say it's more than $1 billion, they have very limited ability to hedge it in crypto derivatives, like calls. The max they can do is maybe 5% of their holdings. And then if you go to traditional CME exchanges, their contract sizes prevent someone from hedging $1 billion portfolio. However, someone can use MicroStrategy's options chain, which is so liquid, to hedge all of their crypto. So MicroStrategy is essentially absorbing all the hedging pressure that the crypto industry is trying to do to protect their Bitcoin longs. So the reason MicroStrategy is a leading indicator, it's actually the only convenient way to hedge someone's long is to short MicroStrategy or buy puts. That's what we're seeing today.
This is the kind of stuff, Tom, it's one of the main reasons that we bring you on, because you understand what I would consider the engine oil of the stock market, right? We know how the engine works, or people think they do, but inside that engine, there are gears, there are pistons, there are things that are occurring that for 99.9% of our audience, they don't do this for a living. We get it. This is a really important interview. I'm going to let you go, Tom. We are watching MicroStrategy or Strategy. We're watching Bitcoin, and we're watching possibly 77,000, which you think might be kind of a washout period, correct?
Yeah, that's right. Tom DeMark, who is an advisor to BitMine,
very well known to me,
really giving us a lot of insights. Yeah, he's watching that. Actually, MicroStrategy at this level here probably is when you want to ratchet into the longs, and Bitcoin maybe just a few $1,000s lower.
So
I think
we might be at a bottom for Strategy.
Yeah.
Looking at maybe the DeMark indicators named after Mr. Tom DeMark. It's a technical indicator watched by a lot of hitters on Wall Street. Tom Lee of Fundstrat, appreciate your time. Really super smart interview. As always, Tom, have a great day. Thank you.
Thank you.
Hey, Morgan. So as soon as Bitcoin pivoted into sell-off mode and broke below that key $90,000 threshold, tech equities like NVIDIA quickly followed suit. Now, analysts say algorithmic traders are using Bitcoin as a proxy for speculative appetite. So when it rolls over, it signals that risk-taking is drying up across the board. Now, this all stems from that massive liquidation event last month, which knocked out key market makers, the ones who usually keep trading going smoothly. And without that support, even small sell orders can move markets. Now, we've been in a slow unwind ever since. Bitcoin is now down more than 30% from its recent all-time high, and the fallout is hitting crypto-adjacent names the hardest, including exchanges like Coinbase and Robinhood. But one name that is taking the brunt of that pressure is Strategy, the most liquid public proxy for Bitcoin. It is down 40% in the past month. When hedge funds can't hedge their Bitcoin exposure directly because derivatives markets are too thin or contracts too large, they short names like Strategy instead. It has become the release valve for hedging pressure across the industry.